Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. Today, I want to jump right into it and give you the breakdown of what compounding interest is really, because I had a lot of questions on public today about like, what is compounding interest? How do I really like profit from it? How does it work in the stock market? Like, it sounds great, but what does it really mean? And compounding interest is like the key. It is the key, the secret, whatever it is you want to call it, the secret ingredient really of investing. If it weren't for compounding interest, wouldn't none of us be here, right? And when I say us being here, I mean like in the stock market, watching this video, stuff like that. So I'm going to go ahead and break it down in a way that I hope makes a lot more sense than like just reading an article out there somewhere. Also, as you know, I started my career, as some of you know, started my career as a teacher. 2012, Dallas, Texas. Shout out to your boy. Ann Richards Middle School is where I taught, and I taught 7th grade math. Now, I don't consider myself a math genius by any stretch of the imagination, but I was a really good math teacher. And then I jumped into finance, and that's kind of where I learned a lot of this stuff that we're going to talk about here. So we're gonna get to the whiteboard. Classes in session. As always, in my classes and my environments, make sure that you hit the like button, ask questions if you have any, and make sure you hit the share button. YouTube, Instagram, Facebook, wherever you are, hit the share button, let people know so that you can educate others as well. Lastly, I am teaching some classes this weekend, so make sure that you check that out. I'm going to give you a 6-figure investing plan. Okay, so how do you hit 6 figures? Because that's the key number. We talked about that yesterday in the previous video, because you might be watching this a year from now. I don't know. Make sure you go to BillNumerator.com/free class. Totally free. Make sure you register and take that class. All right. So let's go ahead and jump into it. So compounding interest is essentially, if you were to boil it all down, is when your money makes more money. That's it. If I put in $100, my $100 makes, let's say, $10, right? And now my $110 makes $11, or however you want to say that. Okay, so I'm gonna break it down and really show you the power of how this works, and how you as an investor can truly make a difference and profit off of compounding and compounding interest. All right, so let's go ahead and share the screen real quick. Won't be long. Don't plan on being long. Y'all know I be ranting sometimes. All right, so here's how you break it down. So let's say that you want to invest $100. Okay, so you've got $100. And let's say that, let's say you're on the public app, which you should be. I'll put the link in the bio if you're not already, so you can follow me and others and learn more about investing. But let's say you put in $100. I like to use Disney as an example, not recommending you to buy Disney or anything, but everybody knows what Disney is and what they do. So let's say that you make 10% on Disney. Okay, so that means that you made a $10. I'm just going to put profit. Okay, you made a $10 profit, and now you have $110. Great, you made $10. Now, the compounding part is the next cycle. Let's say you did this for a year. So let's do 2021. You invested $100, you got a $10 profit, now you have $110. So in 2022, and this doesn't mean that the stock market goes up 100% of the time. It didn't go up 100% of the week, right? So let's say this time you take that same 110, you leave it alone, and you just let it compound on its own. So this time, let's say that this is consistent, that you are still getting 10%. Now, the stock market is unrealistic. It's the exact same return every single year. But again, this is just a hypothetical. This time, though, you make $11. Why do you make $11? Hold on, let me add this up. So this time we get $121. Now, why do you make $11 this time around? It's because it's not 10% of 100 anymore. It's 10% of 110. So that's the compounding interest. And this is where things start to get interesting. It goes from 10 to 11, and that starts to really explode the longer that you do this. That is the basis of compounding interest. That's what happens. And the beautiful thing about the stock market is one of the easiest places that you can start to do this. Why? Because if people argue like I want to do real estate and I want to do all this other kind of stuff, that's totally fine. But you're not going to find a house that you can start investing in for just $100, or you can keep adding money to very easily, right? Stock market is one of the only places you can do that. Cryptocurrencies is a good place to do it too, or it's a place. I'll say a place because that market can be really, really wild. So this is the concept of compounding interest. And what I'm going to do, what I like to do as an educator of the stock market, is to really hone in on it and show you the realistic returns, right? So we're going to shift over here and show you this. Now, this is ticker symbol SPY. SPY. This is an index ETF. ETF stands for Exchange Traded Fund. This is one of the base investments that most people should have, or a version of it. So I talked about this the other day. SPY, VOO, all similar, right? It's the S&P 500. It's the 500 largest companies in the United States. As an investor, I get to get this, and I get to own pretty much the top 500 companies. You're going to have Disney and Apple and everybody else. Very good base investments. If you don't do nothing else, this is a very good place for you to start. So in this example, we start with, and this is over the last 10 years, or 11 years, really, 2010 to 2021. And in this case, you started with 1,000. So start with 1,000. You start 1,000 one time. I don't add any money to it. Okay. So the first year, you got a 15% return. 15%, you had $1,000. You walk away that first year with $1,151. That ain't bad. That ain't bad at all, right? You leave it alone, okay? 2011, you compound again. Now, this time, the returns are not consistent, okay? So you got only 1.89%. You still made money. This time, you're at 172. 2012, you got almost 16%. And again, you only invested $1,000 one time. You left it alone. And now you're at 1,360. You leave it alone. You keep doing this over and over and over again. And all you did was put in $1,000 in SPY. You left it alone, and you waited 11 years. So you can just scroll down here. You've got 12%, 21%. Now, 2018, it was negative. Okay. But at this point, you've already doubled your money. You went from 2,800 to 2,689. So, you're still up, right? Then the very next year, you went from 21% gain to close to a 5% loss to a 31% gain. That 1 year is why we talk about long-term investing. That I'm not really overly concerned about what happens. Oh my God, the market's down today. I don't care because look at the history of the stock market, right? So I keep going. At the end of the day, I have $4,708. That is almost 5 times more money than what I started out with 11 years ago. That's a one-time $1,000 investment. That's it. One time. And I wait 11 years, and I got 4.7 times more than what I had. So I put in 1,000, I'll walk out with $4,708. Now you may be thinking, well, I want more money than that, right? Like, well, this is not exciting to me. I will never hit $1 million by doing something like this and waiting 11 years. Well, the good news is it's the stock market. You can do things that are more aggressive, and you can add more money to it. So $1,000 a year, or $1,000 one time is just $1,000. But if you did that for a year, that's $83 a month if you spread all of that out. So this is just SPY. This is like super basics, right? So let's scroll down some more. And this one is JP Morgan. So y'all know I'm really got my eye on the finance industry for this year, for the second half of 2021. I'm leaning towards JP Morgan, so that's why I did this one, but there are other ones out there. So again, $1,000. $1,000 invested one time, the exact same time frame, 2010 all the way to 2021, and the returns are a bit different. You said first year you only got 2.3%. This is the risk. This is the risk when you are investing in individual stocks. I don't have the benefit of having 500 companies, that diversity, right? JP Morgan is just either going to be it or it's not. Remember also in that last chart, you had 1 year that was negative. JP Morgan has 1, 2, 3. You got to be okay with that, right? If you're a long-term investor, that's the breaks, right? You got to be okay with that. However, we'll skip all the way down, and you will see you actually ended up with more money at $5,264. So this is 5 times more because of compounding interest, right? And it wasn't always a straight line. You see this year, I probably would have been happy at 819. Not happy at all. However, Again, this is that compounding interest for you. This is what it looks like. Your portfolio balance would have been more than five times higher if you had left it alone and let that money compound. Okay, so we're going to do one last example. So in this example, again, this is JP Morgan, same time frame. Now this is starting with $1,000 plus $100 per month. Okay, so I started with $1,000. So I got a stimulus check. Say I saved $1,000, whatever, however you get $1,000. But this time I'm adding $100 a month, right? This is what I do, except I do it weekly on Public. So I'm adding more money every single week. So this even, you can really say $400 a month if you want to do it that way. But in either case, I'm adding more money to it. And watch how quickly or how, in comparison, watch how fast this money grows. So in 2010, you start off, you've got $2,325. The next year, you're still up. And that's the cool thing, right? Now, in the first example, you put in $1,000 and it drops at 19%, then you're down to $819. In this case, you're up. You're up. You're higher than what you were the year before because, again, you're adding money. That kind of goes to that DCA point, dollar cost averaging. I think this was 2 days ago. We did a video about that. Make sure you check that one out. And you'll see how even when the stock is kind of down, you can actually kind of help yourself out by doing DCA. This is one example of that. You keep going. You're at $5,000. Then down here, you're at $20,000 at the end, the exact same time frame. You have $53,000 in 11 years. And the only difference between this one and the last one is that you just decided to add $100 per month. That was it. $100 per month is $25 a week. That's it. $50,000 in 11 years. Now, again, you can always be more aggressive. You can say, well, what if I want $100,000, which was the metric that I said, if we get $100,000, everything gets easier. Well, if you doubled that and did $200 a month or $50 a week, maybe you would have doubled that up and gotten to $103,000. If you wanted to be more aggressive, let's say you did something like a Tesla, maybe a Google or an Apple, you might have got these numbers a lot quicker, right? So it's always going to depend on what it is that you decide to invest in. That's a question that you have to answer for yourself and how quickly you want to get there. However, the key is that compounding makes a big difference, right? You go from $1,000 one time and you just leave it alone, something like the S&P 500, an index fund, you can get, $4,000 out of that in a longer time period, but you get to sit back. All that money was passive. I didn't have to really do anything for it. Put the money in, choose what I think is a good investment. You sit back, let the profits come in over time. It's not going to be 100% consistent. It's not going to be 15% every year. It's not going to be 5% every year, as we saw with JP Morgan and others, right? But that's the power of long-term investing. I did not hit that six-figure mark and beyond by picking the right stock every time and being really, really fancy. If you watch me on Public, you will see that I almost never sell up until June and December. That's it. And usually I'm not even doing a whole bunch then. I'm just getting rid of the stuff that I'm ready to switch out. I didn't make a whole bunch of money on, or I lost, and that's it. But stuff in that long-term portfolio, the Apples, the Googles, the Amazons, they ain't going nowhere, right? That is how you do it. I could have put Amazon in here, put Apple in here, numbers would have been completely different. But the concept, right? The concept of compounding interest would have been the same. So all you have to do to take advantage of compounding interest is to buy into whatever it is you think fits for you, hold, and continue to add to that investment. That is the key to wealth. Again, something like an index fund, SPY, VOO, those are ticker symbols. That's like most people who are successful put their money in, they don't look back, and they do that for years at a time, and they do incredibly well. People who want to take a little bit more risk and say, I want to get there a bit sooner, they do stuff like JP Morgan, maybe Disney, Apple, whatever else is out there, what they think is quality, right? And they get there, okay? So that is how compounding interest works. I I'm hoping that was in 10 minutes. I don't know. I wasn't really looking at my watch at that point in time. So, all right. So that is it for me. Make sure that you sign up for the free class, how to create your six-figure investing plan. I will talk to y'all later. Thank you for the questions in the comments. If you have any more on this video, let me know and hit the share button so we can get more people in here to learn about the stock market from perspective of we one-on-one. I like teaching people. So I want to make sure I can do that for y'all. All right. That's it for me. Talk to you guys later. Bye.